All right, I'm back with another weekly market update. I'm Paul Lapis with Remax Hallmark here in Toronto, and I want to talk a bit about what's going on in the Toronto real estate market, the headlines for inflation, the mortgage data. So lots to go over this week. I want to start with inflation. So that was the big headlines coming out. January's numbers, inflation came in softer than expected at 2.9%. That's down nearly 0.5% from where it was in December, and much lighter than where they expected or where they were predicting for January. So that was a good sign that inflation's starting to come down. It's been pretty sticky. Uh, the biggest kind of pull on that is gasoline prices coming down 4%. And the big number really is the core inflation or core CPI that the Bank of Canada looks at. That one was higher. That came in at 3%. It is down from December by about 0.3, but that's the big one that the Bank of Canada uses for setting their targets, and that came in higher above their ideal target window. An interesting fact I learned that came up from the chief at BMO was that really, without mortgage interest costs, our CPI would be at 2%. So mortgage interest cost is up 27%. It's a huge kind of lift on the inflation, and without it, it would be really, like I said, at 2%. And comparing, our CPI to other countries like Eurostat and the US's BSL, who don't use mortgage interest costs, it would show that our inflation is actually within the target window for the Bank of Canada. The next thing we're looking at is what does this mean for Bank of Canada rate cuts? So this is kind of our data has been diverging from the US, with their inflation numbers coming in higher and their economic data coming in stronger than the Canadian economy. This could mean that we're looking at a divergent of maybe Canada potentially making rate cuts before the US, which if talked about, maybe in November, December, wasn't expected, whereas Bank of Canada was holding much firmer for much longer. The U.S. Federal Reserve was talking about cutting rates sooner. Now it's looking like the tables have turned, and the Canada could be cutting rates sooner. That being said, we're still not talking about rate cuts really until June, maybe even being pushed back to the fall. Inflation's still higher than the Bank of Canada would like, and some of the economic indicators are still higher than what they're hoping for. So they're going to hold on, and as long as the economy is staying, stronger than anticipated, they're going to hold those rate cuts out for longer. And even the predictions, the market predictions for those, have come down to about 0.75% within this year of rate cuts, down from its 1.5 to 1.25 predictions just a few months ago. So those are definitely kind of softening as the economy has either inflation has been stickier or the economy has been doing better. We're likely going to see less and fewer and less of an amount rate cuts. The other thing I want to talk about is the supply side. So, housing starts plummeted down to 10%, and really we're down 18% from November's peak in housing starts. Costs associated with building and interest costs still remain high and still kind of creating a barrier for people to take on and builders to take on new housing start permits. So we're likely at the peak for housing completions being done right now. As housing completions, the amount of units under construction are still high, and likely those completions will start kind of dropping in 2024 as new starts dwindle. We're likely going to see the roles flip and reverse on that. Really, when you look at the housing starts too, most of the decline came from multi-res, whereas single-family residential is still at all-time low for housing starts. The last thing kind of want to look at here would be around the mortgage update. So really, mortgage originations have declined in December. They're down about 14%. But an interesting point is that people are starting to skew towards variable. So with the talks of potential rate cuts this year, people people who are looking for new mortgages or reaching out to renew their mortgages, there's a higher and higher percentage looking at variable. And so we went from the low 6% up to 20%, and even some industry professionals saying it's going on as high as 30% of new mortgages coming in at variable. So that's an interesting trend to watch as people are banking on variable rates coming down sooner than expected. Mortgage volume, though, however, remained quite stagnant. Only, up 0.2% month over month and up 3.3% year over year. So the volume of mortgages aren't really growing. It's holding quite steady. And compare that to credit card debt, that is up nearly 13% year over year. So that's something that we're going to want to watch, as credit card debt is not good for the economy. It's high interest debt that consumers carry. Now, that being said, arrears for mortgages have remained flat and like stagnant at 0.17%. So we haven't seen an uptick in arrears for mortgages, although credit card debt has climbed. For more mortgage and real estate information like this, to keep it posted on the economy and how that impacts real estate, please like, subscribe, or write a comment if you have any questions. Thanks for tuning in.